You know, in the previous video on how to learn to wait for setups, I told you that patience is the trader's greatest weapon, and that patience finds its sharpest test during consolidation. Now, I want you to picture this as stock moves strong, everyone's eyes are on it, the crowd is buzzing, and then, suddenly, it stops. The action quiets down, the tape prints dull, and the market looks like it has lost all interest. That's what most see, but to a trader with trained eyes, that quiet is louder than any move on the board. Consolidation is not nothing, it is everything. The market is not asleep during those times, it's storing up energy, like a spring pressed down, tighter and tighter. And when it lets go, when it breaks, the move that follows is the real thing. Have you ever seen a coiled spring resting on your desk? Looks harmless, right? But the moment you press it down and release, it shoots across the room. That's the breakout waiting inside consolidation. But here's the rub. Most people can't stand to watch it sit there. They get fidgety. They say, "This stock is dead. Nothing's happening, let's move on." And in that moment, they fail the test. Because the market isn't just about movement, it's about timing. And timing comes from being able to watch stillness and not blink. Now let me ask you, do you have the nerve to sit there while nothing seems to be happening? Or do you chase every flicker of action because silence makes you nervous? You see, the reason most traders never profit is because they misunderstand what consolidation means. They think it's the end of a move. They think it's boredom. But I tell you, it is the market gathering its breath, getting ready for the next run. If you don't understand that, you will always enter too early or too late. You'll be the fellow jumping out just before the real show begins. When I studied the tape as a young man, I noticed that the great winners' stocks that doubled, tripled, and kept climbing did not move in one straight line. They advanced, they paused, they digested, and then they advanced again. Each pause was consolidation. Each pause was the crowd arguing with itself, is this price too high, or is it still cheap? And while the crowd debated, the professionals quietly built their positions. You see, the money is not made in chasing prices. The money is made in recognizing the points where the stock is telling you, I'm ready to move again. Think of it like this. You wouldn't judge a man's strength while he's sitting still, would you? You'd wait to see him lift a weight, to watch him spring into action. The same with a stock. You watch the pause, but you don't judge the pause. You judge the action that comes out of it. And that's why the calm before the breakout is more important than the breakout itself, because it tells you the quality of the move. Now, why does consolidation matter so much? Because it separates the amateur from the professional. The amateur wants action every day, every hour. He buys because he's bored, and he sells because he's scared. He looks at the pause and says, this is dead money. But the professional sees the pause and says, this is opportunity in disguise. Have you ever thought about that difference? It's the same market, the same chart, but two minds reading it two ways. Which one are you? You must train yourself to look at consolidation as the market's way of testing you. Testing your patience, testing your nerve, testing your ability to wait for the right moment. Because wealth in this game does not come from taking every trade. It comes from waiting for the right trade. That's the point we touched on before, about waiting for setups. And here, in consolidation, that lesson becomes flesh and blood. You either learn to wait through it, or you give up your edge to the man who can. Let me tell you a truth I learned the hard way. The market does not reward the restless. It rewards the disciplined. When you watch a stock base moving sideways, what you're really seeing is a battle. Buyers and sellers locked in combat, neither willing to yield. The range tightens, the volume dries up, and the price moves into a corner. And then, when one side finally gives up, the other side wins with force. That's the breakout. That's where fortunes are made, not because you guessed, but because you waited and read the tape. And I want you to ask yourself this: can you endure the waiting without losing faith? Because most can't. They'll say, it's not moving, let me sell and move on. And just as they leave, the stock explodes without them. How many times has that happened to you? If you're honest, you've seen it, and that sting you feel, That frustration that's the cost of not understanding consolidation. I tell you, the calm before the breakout is like the still air before a storm. It feels quiet, but if you've lived through enough storms, you recognize the signs. You smell it, you feel it, you know it's coming. The tape tells you, if you know how to listen. The narrowing range, the shrinking volume, the dull days, these are not the signs of death. These are the signs of life, about to burst. But you must learn to see it for what it is. Money in markets is made by aligning yourself with those bursts of life, not by forcing trades when the market has nothing to give. That's why I never feared the quiet periods. I embraced them. I said to myself, this is the market teaching me patience. And every time I sat through a consolidation and caught the next big move, I became richer not just in dollars, but in discipline. Now, remember this, the market doesn't owe you action. It doesn't care about your need for excitement. It will sit quiet as long as it pleases, and if you can't handle that, it will take your money and hand it to the man who can. So when you see consolidation, don't curse it. Don't complain. Respect it. It's the most honest teacher you'll ever have. When you see a market quieting down after a run, the price narrowing into a smaller range, the candles overlapping one another like tired soldiers at rest, you must not let your eyes deceive you. Most men do. They look at a chart and say, this thing is going nowhere. They grumble. They grow impatient. They start hunting action in other names. But the truth is, those dry stretches are not accidents. They are the telltale signs that the stock is preparing, and nothing speaks louder in those moments than volume. Or rather, the lack of it. Volume is the pulse of the market. It is the heartbeat of every move. When prices are rising and volume swells, you can see demand, raw and visible, carrying the stock higher. When prices are falling and volume swells, you see supply overwhelming demand, pressing the stock downward. But when a market pauses, and the volume begins to contract, that is where you must pay attention. Because contracting volume is not silence, it is the market whispering to you that supply is drying up. Think of it this way, when a stock runs up strongly, many players rush in. Some ride the move early, others chase late, and some come in at the very top because they can't resist the story. But once that run has spent itself, what happens? Those who bought early have profits and are willing to sell into strength. Those who chased late are often trapped, waiting for the stock to come back to them. And the buyers? They need time. They need the supply to clear out before they can force the next advance. So the market rests. The stock trades sideways, up and down in a narrow band. Every dip invites a few more sellers. Every rally shakes loose another batch of weak hands. And day by day, as the volume contracts, the sellers are used up. Their urgency is gone. Their selling power is absorbed. Have you noticed how, during a consolidation, the daily bars get smaller, the range is narrower, and the volume shrinks? That's no accident. That's the market telling you the pressure to sell is fading. Those who wanted out have gotten out. Those who remain are stronger hands. They are not anxious to sell at the current levels. That is why the tape grows dull. It's not death, it's digestion. Let me ask you something. How many times have you been shaken out of a stock during a quiet spell, thinking the move was over, only to watch it break out days later without you? That sting is the cost of not reading volume contraction correctly. You saw quiet and thought it meant weakness. But the professional sees quiet volume and knows it means strength. Why? Because the best moves never come when everyone is shouting and cheering. They come after the shouting has stopped, when the market seems forgotten, when the volume is light and nobody cares anymore. That's when the stage is set. I learned this truth years ago by watching tape. I noticed that the great leaders, the stocks that would double or triple, always had these resting phases. They would surge, then tighten, then rest with declining volume. And during those rests, I would see the tape print fewer and fewer shares. At first, I thought it was weakness, that interest had died. But when the breakout came, the strength of the move shocked me. It was as if the stock had been building a reservoir of force hidden beneath those quiet days. And then I understood it wasn't weakness at all. It was the absence of selling. The path was clear. A stock cannot advance if there are too many willing sellers. Every buyer will be met with resistance, every rally sold into. But when the sellers are gone, the buyers don't need to fight anymore. A little buying pressure sends the price higher and higher and higher because the supply is thin. That's why the drying up of volume is the strongest clue that the stock is ready to move. Let me put it in plain language. You don't want to see heavy volume during consolidation. If you do, it means sellers are still active, supply is still abundant, and the base is not ready. But when volume dries up, when the market looks lifeless, that's the signal. It tells you the stock is being transferred from weak hands to strong hands. The amateurs are gone, the restless have left, and only the patient remain. And patience in the hands of strong holders is the soil in which great advances grow. Do you see how this ties back to your own psychology? Most traders can't stand boredom. They want excitement. They want to see action every day. But the market doesn't reward excitement, it rewards discipline. If you sell out just because the stock is quiet, you will always be handing your shares over to the professional who is quietly accumulating during that dull period. He sees what you don't. He sees that the absence of volume is not the end, but the beginning. Picture a great oak tree. In summer it stands tall, green, alive. Then winter comes. The leaves fall. The tree looks dead. But underground the roots are alive, drawing strength, storing energy for the next season. That's what consolidation with contracting volume is, the winter of a stock. It looks dead, but it is gathering strength. And if you mistake that for death, you'll never own it when spring returns. Let me ask again, when you see a stock trading in a tight range, volume drying up day after day, do you walk away or do you wait? Because that one choice often decides whether you make a fortune or miss it. It is not enough to know where a stock has been. You must know what the volume is telling you about where it is going. And contracting volume is the market's way of saying, supply is almost gone. Get ready. In my own campaigns, I learned to love those dull periods. The tape would grow so quiet you could almost hear your own breath. And that quiet was worth more to me than the loudest rally, because rallies can be false, but a long stretch of dullness with volume drying is never false. It is truth. It is the sign of strength hidden under weakness, of preparation hidden under boredom. This is why the amateur and the professional see two different markets. The amateur sees contracting volume and thinks, nobody cares about this stock anymore. The professional sees contracting volume and thinks nobody's left to sell. The road is almost clear. The first man sells his shares cheap. The second man holds or quietly adds. And when the breakout comes, the difference between those two mindsets is the difference between regret and profit. And here's another thing. When the breakout finally happens after a period of contracting volume, the move is often explosive. Why? Because the lack of sellers means buyers don't have to fight for every inch. Prices gap, they surge, they catch the crowd by surprise. The public, who ignored the stock during its quiet base, suddenly wakes up. They rush in, adding fuel to the fire. But by then, the professional is already in position, thanks to the discipline of waiting through the dull days. Do you see how crucial this is to wealth building in trading? Money is not made by chasing noise. It is made by anticipating quiet. The man who understands volume contraction knows where to look while others are distracted. He knows that boredom is the market's camouflage, and behind it lies opportunity. But only if you have the nerve to sit still, to endure the quiet, to trust the signs that supply has dried up. Because every great move in history, every campaign I ever profited from had this signature, a base, a pause, a contraction in volume, and then a breakout. The pattern is as old as markets themselves. It is human nature written on the tape, and until you learn to recognize it, you will always be selling too soon or buying too late. Patience through consolidation is the real test of a trader's discipline. Anyone can buy a stock when it is running hot, when the crowd is cheering, when the tape is fast and the stories are exciting. That part is easy. The newspapers will carry the headlines, the neighbors will talk, and the price action will make it feel like money is raining from the sky. But when the move pauses, when the stock begins to trade sideways, the noise fades, and the tape prints Dull, this is where most traders lose their nerve. And this is where the difference between fortune and failure is quietly decided. The market has a cruel way of punishing impatience. A man buys a stock because he sees strength, he feels momentum. Then it stalls. The range tightens, the volume dries up, and nothing seems to happen. Day after day, the price moves within a narrow band, teasing but not delivering. What does the average trader do? He grows restless. He starts questioning the wisdom of holding. He tells himself, I could sell this and put the money to work somewhere else. And more often than not, he does just that. He sells in boredom or in mild frustration. And then, not a week later, the stock breaks out and runs without him. He watches from the sidelines as the move he dreamed of finally arrives. Only now he is not aboard. Have you ever lived through that cycle? Bought a stock, waited a little, gave up, and then saw it surge just after you left? If you're honest, you have. Every trader has at some point. That pain, that feeling of being tricked by the market, is not bad luck. It is the direct consequence of not learning patience during consolidation. The market isn't cruel, it is simply indifferent. It demands discipline, and if you don't have it, your money will be taken by the one who does. Now let me tell you something I learned early. Consolidation is not punishment, it is preparation. A stock doesn't run in straight lines forever. It advances, it rests, it advances again. The resting periods, the consolidations, are necessary. They clear out weak hands, they absorb supply, they give time for new buyers to step in. Without them, the move would burn itself out too quickly. So when you see consolidation, you must not think of it as wasted time. You must think of it as the market's way of loading the spring, and the man who can wait through it will be there when the spring uncoils. But waiting is not easy, because it goes against human nature. Human beings are built for action. We crave movement, progress, excitement. We feel alive when things are happening, and restless when they are not. The market knows this. That is why it uses time as a weapon. It bores you out of your best positions. It tests your discipline, not in moments of chaos, but in moments of silence. Can you sit still when there is nothing to do? Can you hold your ground when the tape is dull? Can you resist the urge to sell just because the market is not entertaining you? These questions are at the core of trading success. Think about it. If trading were only about spotting moves, every man would be rich. The charts are there for all to see. Breakouts are not hidden. Trends are visible. The reason most fail is not that they cannot see, but that they cannot wait. They want every day to bring action. And because they cannot endure consolidation, they are never present when the real money is made. The stock breaks out, runs without them, and they tell themselves, I'll catch the next one. But the next one is the same story all over again. This ties directly back to your mindset. Trading is not about activity, it is about alignment. You must align yourself with the rhythm of the market, not with your own craving for action. The market does not care about your boredom, your impatience, or your need to feel busy. It will move when it is ready, not when you want it to. And consolidation is the market's way of saying, not yet. If you cannot accept that, you will always be paying tuition to those who can. Let me ask you, what is harder, buying a breakout or holding through consolidation? Most will say buying the breakout is harder, because it requires courage to pay up. But I tell you, holding through consolidation is the greater challenge. Because during consolidation, doubt creeps in. You question the story, the setup, your own judgment. You feel the pressure of time. Your capital is tied up, and you wonder if it could be working harder elsewhere. That slow grind wears men down more than any sudden drop ever could. And yet, those who endure it are the ones who reap the reward. Patience in trading is not passive, it is active discipline. It is the conscious choice to do nothing when doing nothing is the right move. The amateurs confuse inactivity with weakness. They think that if they are not trading, they are falling behind. But the professional knows that waiting is part of the campaign. He knows that the true work is not in chasing every flicker, but in holding his position while the market builds energy. When you learn to wait through consolidation, something changes inside you. You stop needing the market to entertain you. You stop fidgeting with your trades. You learn to see the bigger picture. The tight ranges, the drying volume, the quiet days, all of these become signals, not obstacles. You realize that the quiet is just as important as the noise. That realization is what separates the speculator from the gambler. The gambler needs action every minute. The speculator needs only the right action at the right time. Think of the great campaigns in market history. None of them were one-way roads. They all had stretches of consolidation, periods where nothing seemed to happen. But those who held through those periods made fortunes. The others, those who sold out in boredom, walked away with scraps. It was never about who spotted the trend. It was always about who had the patience to sit through the pauses. You remember in the previous discussion about learning to wait for setups, we spoke about how the best trades are few, and you must save your capital for them. Well, consolidation is the living proof of that principle. The setup doesn't complete in a day. It builds slowly, painfully, over weeks or months. And your ability to wait through that process is what determines whether you will be part of the big move, or just another spectator. Now I'll ask you plainly, do you have the discipline to wait? Or do you need the market to move every day just to feel alive? Because if you need that, the market will drain you. It will feed on your impatience. But if you can sit quietly, with your capital in position, waiting like a hunter in the tall grass, then you will find that the biggest profits come not to the busiest trader, but to the most disciplined. Professionals accumulate quietly during these quiet periods. That simple truth is the key to understanding why consolidation matters so much, and why most people miss the boat while a few walk away with the profits. When the public sees a stock sitting still, drifting sideways, trading within a narrow band, they think nothing is happening. They see boredom. They see wasted time. But the professional, the man who knows the tape and understands human behavior, sees something very different. He sees opportunity. He sees accumulation. Now, what does accumulation really mean? It is not a loud event. It is not the kind of thing you'll read in the headlines or hear in the chatter. Accumulation is quiet by nature. It is the process by which the strong hands, the big operators, the institutions, and the seasoned traders take stock off the public's hands. They don't do it in one giant bite. That would alert everyone. They do it patiently, day by day, order by order, absorbing shares while keeping the price within a range. To the casual eye, nothing changes. To the trained eye, everything is changing. Think about it this way. When a stock has run up and then pauses, there will always be sellers. The early buyers have profits, and they're happy to cash in. The latecomers who bought near the top feel nervous, and they're eager to get out even. Those with no conviction will sell simply because the stock has stopped moving. All that supply must be absorbed before the next advance can begin. But who is on the other side of those sales? Not amateurs. Amateurs are the ones selling. The buyers, the ones picking up those shares in quiet moments, are the professionals. And how do they do it? They never rush. A professional knows that his own buying can move the market if he's careless. So he breaks his orders into pieces. He lets the market come to him. On a weak day when the crowd is discouraged, he buys a little more. On a strong day when prices rise, he lets the sellers come to him and absorbs their supply. Slowly, quietly, over weeks or months, he builds a position. And all the while, the stock appears to be going nowhere. That's the camouflage. That's the trick the market plays on the untrained eye. Have you noticed how often the great moves begin after long, dull periods? That dullness is not an accident. It is the mark of accumulation. The professionals have no interest in broadcasting what they are doing. They would rather the public fall asleep, lose interest, and sell out of boredom. The fewer eyes on the stock, the easier it is to take in size without resistance. And by the time the breakout comes, the professionals are already aboard, while the crowd is caught off guard, scrambling to buy what they sold weeks earlier. Let me ask you directly, when you see a stock trading sideways, do you assume it's finished? Or do you stop and ask yourself who might be quietly taking the other side of all those small trades? Because someone is always on the other side. And if you don't know who it is, it might be you handing your shares to a man who understands the game better than you. The discipline of accumulation is something I learned by watching the tape for hours, days, years. I saw the same rhythm over and over. Price would surge, then pause. During the pause, volume would decline, the tape would grow dull, but every time a nervous seller dumped shares, they were absorbed. Not in a dramatic way, but steadily, consistently. Then, when the selling dried up and there was no more supply, the stock would break out. The move would look sudden to the untrained observer, but to those watching closely, it was inevitable, and this is where psychology plays its part. The public hates to wait. They want quick profits. When the action slows down, they lose interest. They start chasing something else that looks livelier. They sell their shares to fund the next hot idea. That's exactly what the professionals want. They feed on that impatience. Every share that leaves weak hands during consolidation is another share placed firmly in strong hands. This transfer of ownership is the very definition of accumulation. Now let's talk about why accumulation during consolidation is so powerful. Once professionals have absorbed enough supply, the balance shifts. Sellers are gone. The float is concentrated in the hands of holders who believe in higher prices. When new demand comes in, there's no resistance left. The stock doesn't crawl, higher it jumps. That's why breakouts from accumulation phases are so strong. They're not random. They're the natural result of weeks or months of quiet buying. You may wonder, how can you tell if accumulation is happening? You won't see it in a headline. You won't hear it in gossip. But the tape gives clues. Volume dries up as the stock tightens, but every dip is supported. Price refuses to break down. Sellers show up, but they are absorbed without drama. The stock doesn't collapse, it holds firm. This is the hand of accumulation at work. It is subtle, but once you train your eyes to see it, you'll never mistake it again. Have you ever noticed how some stocks just won't go down, no matter how bad the news or how weak the market? That stubbornness is a classic sign of accumulation. The professionals are in there, absorbing supply, and they will not let the price break because they want the shares. They are playing the long game, while the public is playing the short one. And when the breakout finally comes, the professionals don't chase it, they ride it, because they were in long before it began. This ties directly into wealth building as a trader. The big money is not made by chasing moves after they've started. The big money is made by recognizing when accumulation is taking place and positioning yourself early. That requires patience, observation, and the courage to act when the crowd is bored. It requires you to buy when nothing is happening, to sit quietly while the professionals do their work, and to wait until the market tips its hand. Most traders cannot do this. They need action. They want excitement. And so they forever miss the very process that creates the great advances. You must learn to love those quiet periods. They are not the enemy. They are your opportunity. While others are yawning, losing interest, or selling in frustration, you must be asking yourself who is buying, who is willing to sit here, day after day, taking the other side of every discouraged seller. Because that is the smart money, and that is the company you want to keep. Consolidation is not inactivity, it's stored energy waiting for release. Most traders, especially the inexperienced ones, look at a stock that's stopped moving and they sigh. They say, "This thing is dead, nothing to see here." They shut the chart, or worse, they sell their shares because the market has gone quiet. But the stillness of consolidation is not the end of a move, it's the most critical phase of it. It's the market pulling back the bowstring, winding the coil, holding its breath before it explodes into action again. The human eye is trained to chase motion. We get excited when the chart is alive, when prices are swinging, when the tape is buzzing with volume. But the truth is, the noise and the speed are only half the story. The real story, the one that matters for the big money, happens in the quiet spaces. It happens when the price tightens, the volume dries up, and the market looks like it's asleep. That's when the energy builds. That's when the groundwork for the next advance is laid. Think of a spring lying on your desk. At rest, it looks harmless, like it has no power at all. But press it down with your hand, compress it, and suddenly you've created potential energy. Let go, and the spring leaps across the room. That's exactly what consolidation is in the market. It's the compression phase. The longer and tighter the stock trades within its range, the more potential energy it is storing for the breakout that will follow. Have you ever noticed how some of the strongest moves come right after the dullest stretches? A stock that nobody is talking about suddenly erupts, leaving the crowd in disbelief. That eruption doesn't come out of nowhere. It comes out of stored energy built during consolidation. Every tick sideways, every narrow bar, every low-volume session is like another turn of the crank, building the pressure. And when the lid finally comes off, the move has force behind it. That force is what makes the difference between a shallow pop and a real, sustained advance. Now, here's where most traders fail. They mistake the quiet for weakness. They think if a stock isn't moving, it's because demand has dried up. But demand doesn't vanish in consolidation. It rests, it waits. The buyers are still there, but they are patient, and they want to absorb the supply without driving the price too high too quickly. Consolidation gives them that chance. It allows the market to breathe, to reset, to prepare for the next phase.